You should be good though.
All right, you guys, let's go ahead and grab a seat. We're gonna get rolling here. All right. Sounds like you guys were having some good conversations. But ultimately here, Ryan, we've known each other for a little while. But this is probably one of the top 3 questions I get, whether it's from the radio show, whether it's from this room, going and speaking at brokerages or whatever that may look like. It is, hey Courtney, do you know someone like a hard money lender or someone who can lend, but they're not going to, my debt to income's not going to be brought into the picture here or something. This is one of those things that, like, over the years, this is a relationship that I've thought to kind of develop because of that question coming up pretty consistently. Who here has ever used a hard money loan or a DSCR, an asset-based loan? Okay. A few people. Okay. Okay. Well, excellent. All right, so I'm gonna let Ryan come on up here. Ryan, do you want to come introduce yourself? Absolutely. And then we'll let you get going, okay?
Perfect. So first off, big thank you to Courtney for having me here today. And also, by extension, I wouldn't be here without Courtney, but I also wouldn't be here without Steve. So I would just like to say thank you to him as well. Made the connection, a year and a half or so ago, and we don't take that lightly, especially. That's how you're getting a New Jersey lender in front of you here and coming to Louisiana. So
can you guys hear me in the back? You guys good? Excellent.
Can you do me a favor, if you don't mind? It's just a couple quick seconds. If you can take out your phone, if you have one, just scan that QR code, and it'll bring up. It's just going to be a thumbs up. Feel free to come up if you can't see it or something like that. I'll wait a couple seconds so that everybody can get it. But I do think you'll find this kind of cool. So if you don't mind and have the capacity, just take out your phone very quickly and just you'll scan the QR code. It should bring up a link to a website. And I'll give you guys a couple of seconds. If you want, you can hit that. If you hit that thumbs up, it'll reflect right there on the bottom. So I'll know that you actually got it.
Now you got 9, 11, 12.
Perfect. We're getting there.
Man, you're doing the counting for me in the room. I'm like,
We'll make it count. We'll make it work.
You need one of those already?
I mean, like, we're just looking.
Virus,
I promise you this will be very quick, but it will also be worthwhile. I think you'll get something out of it.
I might get my silicone.
Look at that Android. Look at that Android.
Is it not gone? You can also go to the website and type in the code. I will say it's the same.
Okay. Are these all the Android users? No? Every time we do a deal, I'm like, I'm going to slide you an apple across the table at the closing table.
I'm not happy because you're right.
Perfect. All right, so it should bring up, like I said, just a little screen with a thumbs up on it. And I promise you that's the hardest you'll work all night. So very quickly, just going to ask a couple questions here. How many units in your rental portfolio, you can obviously include your personal primary residence here, how many units would you say you own at the moment? And again, we'll give you a couple minutes to get everything answered. Take your time. Yeah. Let me just go back. Don't worry, it's not going to, you'll still see the question up there. Take your time. I guess that begs the question, did everybody that wanted to get involved? My man, if you need me to, I can scan it for you back there. You all good? Perfect. Oh, here, don't worry, there's nothing yet, and I'll make sure there's just quick questions. I'm going to say them out verbally, and you'll see the question.
Just left the room. I was like, he's going to...
You'll actually see the question on your phone as well. And give me just a quick heads up. Did that work for you? All good? Perfect. All right, same question. And if you have, it should pop up, it should already be right there on your phone. I'll give everybody a couple minutes to take their time to answer that. And hopefully this is helpful for you guys to see also who's in the room with you. I think that's pretty good. We had 24 answers. That's about 25 there. Okay, awesome, love it. Next question. What types of properties do you currently own? Residential, meaning 1 to 4 units. Multifamily, over 5. Commercial, meaning more truly commercial, strip malls, office buildings, anything like that, or more than one of those asset classes. You can choose multiple in that one.
This is fancy.
Love this. All right, so mostly in the residential space, which works out great for us because that's really our bread and butter there. Awesome. What's that? That's yeah. I'm the hard question guy. Trust me, we do a lot of that on the front. How have you acquired? And this is just historically. Like, what if you've used all of them? Great, but which one have you used the most in terms of how have you acquired your properties? Cash, traditional financing, be it conventional Fannie Freddie loans, an asset-based loan, which would be the type of financing that we offer, private lending, like truly private lending, like a family or friend, LPs, and then and then creative financing would be like bonds for deed, seller financing, things like that. Mostly traditional financing. So you guys like to go through the underwriting process. All right.
Doesn't like this stuff.
It's a necessary evil, I guess. Okay, perfect. So I think that's about everybody. Couple more, I promise we won't work too hard. How did you acquire your most recent property? Same vein of question. Traditional financing as well, I'm assuming is going to be a big one. Love it. Couple creative financing in there. Cool. Great. Two more. Have you ever used an asset-based or hard money lender? It's a simple yes or no.
Oh.
Well, that jumped from 8 to 17 real quick.
Y'all were like,
Okay.
that's a quick nope.
Perfect.
Wow.
And then last one, just in case there's anybody in here who we may have spoken in on the phone or email, have we ever spoken in the past? I know a couple who I have spoken with, so. Okay, perfect. Well, I appreciate you indulging me in that. So as Courtney mentioned, my name is Ryan. I'm one of the senior loan officers with First Equity Funding. We're a direct asset-based or hard money lender based out of Monmouth County, New Jersey. So we're right in the middle of the state, right on the ocean. About an hour from New York City, about an hour from Philadelphia. Love to have you if you ever want to come up and check it out. But what I'm really going to go over today is just one of a few things. Mostly our products and what we offer, and really just the products that are available in this space, not necessarily specific to First Equity. I'm going to explain who I am, myself, but also the team that we have behind us here at First Equity. Also do a little bit of a commentary on market analysis. So Courtney kind of mentioned a lot of things going on, obviously a ton going on over the last couple of days specifically. So we'll get into a little bit of that. Talk a little bit about supply and demand, some things like that. And also just from last couple things would be a helpful hints, tips type of thing where we're going over as a lender what we would look at and some things that might be helpful for you to know on the front end of things, a little peek behind the curtain, if you will. And then also from an investor's perspective, because most of us in the company, in addition to being lenders, are actively investing in real estate ourselves.
Does the clicker work for you?
That one did not. This
Oops.
one?
Okay.
Yeah. No, it's okay. No problem. So this is part of the team, the majority of the team from First Equity. Ugly mug on the end there is me. The other gentlemen here are Christian Pepe. He's one of our managing partners. We have two. Anthony Palmiotto is our vice president of lending. Corey Anderson is our vice president of sales. These were all individuals who were with us in Biloxi last weekend. So we have a very active and curated presence that we've tried to do throughout, the area specifically.
You stay there and you just point to me or something.
So the first hard money type program that a lot of people associate with hard money is a short-term based loan. So that's generally used for fixing and flipping, just a straight bridge loan. It can also be used as a new construction loan or a mixed-use multifamily loan as well to help acquire and rehab those types of properties.
Are you going to explain what a bridge loan is?
Yeah, absolutely. So a bridge loan is essentially that. It's just taking money from point A to point B, and it's generally a short-term loan, about 12 months, no prepayment penalty, and that's all it is. It's a short-term loan at generally a little bit of a higher interest rate because you're looking to just bridge the gap between when the property sells, when you get it rented out, whatever the case may be for the reason for the bridge, but that's generally what a bridge loan is. It's not based on future value like a fix and flip loan might be. So the benefits of this program are that you can own the property in an LLC. It's experience and asset based. So we're looking at the experience of the borrower and also the personal credit scores. It's really the only two qualifications that we're going to look at. And then there is no experience needed. A lot of the different lenders in this space may require some certain type of experience in the past. We do not. We will just haircut leverage generally. As I mentioned before, it's a 12-month term, no prepayment penalty, which is a big one. Make sure that obviously if you're in a short-term loan, there's not a lot of time as it goes. So just make sure that there's no kind of prepayment penalty in that. Interest-only payments are on funds dispersed. What that means essentially is that it's called full boat versus non-full boat interest. So the way that this program works is we can get you up to anywhere from 75 to 85% of the acquisition of the property. We cover 100% of the rehab through a draw schedule. And then depending on the exit strategy, whether it be to sell the property or to refinance it and keep it as a rental, that would be when this loan is paid off. Does everybody know what a draw schedule is? We'll talk about that, I guess, real quickly. So, Lauren?
Yeah, I mean, the draw schedule is that every time you need to take the money to do some kind of fixing for the property, like let's say you bought a property that needs a kitchen, a roof, a siding, and stuff like that. So let's say you started with a roof and then you needed like $15,000 for it. That's going to be the first period you're going to ask for $15,000 from the lender to get that money, the $15,000, and then the lender is going to give it to you. And do you charge for that? Do you charge every time?
For a draw inspection?
Yeah.
We do. That's very standard throughout the industry, and I will say a couple things. While it is standard for a charge to be brought out for the inspector to come out, we are extremely conservative, or I would say cheap is probably the wrong word, but extremely reasonable in our cost for that. It's generally $125 or $150, where I know a lot of different lenders, anywhere from $200 to $400 per draw request. So that's exactly right. So you do have a line item with your, it's called your scope of work, where you have all of the rehab work to be completed listed. The one thing that Lauren didn't mention is that, so you're paid back in arrears, meaning you do the work on the front end and then we reimburse you based on what's been completed. So just to kind of piggyback off of Lauren's example, say you had $20,000 line item for a kitchen, and you're looking for your first draw request after obviously the loan's been closed, you started the rehab, and you're saying, hey Ryan, it's about 50% completed. Perfect, no problem. Lauren, we're gonna get out an inspector over the next couple of days. We'll make sure that they coordinate with your schedule directly. And as soon as they come out and verify that that 50% of the work has been completed, you get a $10,000 wire into your account within 24 to 48 hours. Does that make sense to everybody? Perfect.
So as far as the reimbursement goes, for example, is that rehabber waiting, like do they have an invoice that they paid and they're getting reimbursed, or that they're waiting on the money from you to pay the builder, the contractor?
That's a great question. So we reimburse you, as I mentioned before, that scope of work is gospel. So throughout the entire process, from when we order the appraisal at the start of the process and we haven't even closed the loan, all the way through these draw inspections. And the one thing the quick note that I will make about the draw inspections is that there is no minimum or maximum on them. You can do one huge draw at the end if you'd like, or you can do the draws periodically throughout the process, whichever works better for your model. But going back to your question, we take that scope of work and we want, like say you had $40,000 for that same kitchen and it only cost you $20,000, and you had $40,000 on your original line item and that was verified in the appraisal as to justify our ARV or after repaired value, you're gonna get that $40,000. So we're not checking your invoices. And that's a really good question. I would think that that's also fairly standard through other hard money lenders, but definitely confirm that with them.
But I guess so clarifying with that is, because I think these are some questions other people may have.
Sure.
For example, are they having to pay the contractor and then waiting for you to get paid?
Yes, absolutely.
So there's some demand of the borrower to have some money to move this along themselves, and they're getting reimbursed from you guys, versus this covering every expense for them.
100%. And there are certain programs I've heard of, I don't know much about them, where they offer 100% financing or things like that. I can't really speak to that because I'll be honest with you, I don't know much about that. I would say that that's in the vein of just a different setup than, that's all I'll say about that.
I mean, you should have some money, but hypothetically, if my contractor sort of like works with me and I tell him I'm going to pay him afterwards, if he didn't take payment at first, you would still pay, right?
100%. Yeah, we.
As long as the work's done.
As long as the work, that's exactly right. So, and that's a very good point, because actually that's a question that I get a ton too, is will you reimburse me for, all right, I bought all the lumber, I bought all the cabinets. Unfortunately, we will not. And this is also very standard as well throughout the industry. We go based on what's completed. And the thought here is, it's more for mobbed up Jersey people, whatever you want to call it, but you know, people, what they were doing is taking lumber that they had purchased, and they had, say, 3 or 4 different flips going on at the same time. They'd move that lumber around and get reimbursements for all of that off 4 different properties when they only bought lumber for 1. So that's the reason that we do buy what's installed, actually, you know, affixed to the property.
Oh, shady work, we have none of that here in Louisiana.
Honestly, it's only in New Jersey, so but I just figured I'd have you out there so you know to.
So it's only in our
look out for it.
politicians. You can keep going.
Right, 100%.
And so the 75 to 85% of the purchase, well, you're getting into that, but it's the idea here that this is a good product for someone who has some money, but not all of them.
Not all the money, and there's, you know, we don't generally, you know, we've started with the market volatility over the last 12 months or so. There's been a little bit more of caring about seasoning loans, or funds rather. We don't try and get into the weeds with that. You know, we're lenders. We're here to fund deals, not find reasons for them not to move forward. But you know, there are certain things. Just as a general overview, when you're talking to lenders or anybody in this space, just make sure that they know what they're talking about, right? And that they're actively involved in their local markets, that they're educating themselves and making sure that they know not only the market, but what they're selling, what they're giving, or providing. So yeah, we kind of went over the leverages, and just a quick note that we can do mixed use and multifamily properties as well in short term. Generally, the requirement for mixed use is that it is at least 50% residential by square footage. 50 to 60, obviously the more the better. This is just a flip that we financed in the local market here. It's on the West Bank in West Wego. Local investors, they took a property and used us for the financing. This was about a year ago. We're good to go, Corey. Also, a couple new construction examples. I'll be honest, the new construction program is a little less utilized from our borrowers just because of the experience requirement. The experience requirement is very high compared to the fix and flip loan program. You can have no experience for the fix and loan program, but not so for new construction. We generally require at least 5 to 7 new builds to use that product. And we can also, just so you know, this was a tough one. These were all 3 adjacent properties, tough from an underwriting perspective. The borrower was great. He's a very, very good local person that I'm sure most of you may know. But these are beautiful properties that he has right in downtown, not far from the quarter. And that was something that was actually a refinance. He had done most of the work, and we kind of came in to help him get everything rent ready. Rental loan, DSCR loan. So this is the other big program that we have. This may or may not be somebody in the room's primary or former residents.
Looks like it's leaning a little bit.
Has a special place in my heart because it helped them acquire their primary residence. But this is an example. This is in New Orleans as well. Qualifications for the rental loan. So the rental loan is a 30-year fixed rate loan. So it's very similar to what you would get going through that process that you went through with your traditional hard money lender or traditional lender who was, you know, FHA, Fannie, Freddie backed. This is very similar to that in terms of the structure of the loan, but very different in terms of the underwriting process, where I'm sure they drove you crazy with asking you for tax returns, W-2s, pay stubs, all that good stuff, looking at your debt to income ratio. We don't factor in any of that stuff. All we're looking at is credit and cash flow of the property. Give me 1 second, we'll have a little opportunity for questions. Cash flow, what we mean by cash flow is what DSCR stands for, is debt service coverage ratio, and that's actually a typo. It's the rental income versus the PITI of the property. So it's the rental income versus the expenses on the property. Very simple metric there. And just so you know, we're not factoring in vacancies. We're not factoring in management fees, utilities, anything like that. Whereas, you know, I will say a big competitor, if you will, not really, because it's not apples to oranges, are a lot of community banks or credit unions local to the area, in any area, will offer these types of loans. but they generally do it on a 20 or 25-year term, amortizing over 5 or 6, 3 to 5 years, or a balloon after that point, or it's an arm, some type of adjustable. So that's the big thing with this, is that this is a true 30-year fix that amortizes over that same term. Just a quick note, we do have a 10-year interest-only period available. You can do it for a 30-year term where it's 10 years up front and amortizes over the remaining 20, or you can do a 40-year term where it amortizes on the front 10 and amortizes over the remaining.
It's over now. Let's go.
That's brand new.
Let's go.
That's brand new. And you qualify off of the interest-only payment, just so you know.
Oh, let's go.
Please.
Hold on, break that, hold on. So it says on there, if you can't read, that they have 40-year loan products available where the first 10 years are interest only, and then it can convert to 30-year principal and interest only. Or if you said you could do one that's 30, but it's 10 years interest only, then 20 years amortized principal and interest. And then you said it only has to qualify based on the interest only payment. Presuming that in 10 years, rents are going to go up, various things like that.
Right.
Steve's over here like dancing in his seat.
I'm like ready. That's awesome. And just, something I've learned is you want a loan constant really low, and if you do the 10-year and the 30-year afterwards, the loan constant's really low because you're
Careful there with the math.
So is that safe? Even if you want to pay it off is there a prepayment? What's a prepayment?
Great question. So there is generally a prepayment penalty, especially, it depends on state law. Mississippi, Louisiana both allow for prepayment penalties. We charge them because it allows us to provide the best pricing available, but it's not our deal to make sense, meaning we need this to make sense for you all before we can move forward. So you can buy that rate down through that prepayment penalty down through the rate. We can always talk about different options. And as I mentioned, we're a direct lender. We are investors ourselves. I share walls with everybody that's going to make a decision throughout the loan process. So we're here to make this work for you.
How long is a prepayment? Like, is it to stop somewhere? Like, is it 5 years?
Generally a 5-year prepayment penalty. I'm sorry if I didn't mention that. It's generally a 5-year prepayment penalty, and it's generally a step down, meaning if the loan is paid off at any point in the first year, it's a 5% penalty. Anytime in the second year, it's a 4% penalty. 3 years, after the third year, 3 years, 3%, and so on. After the fifth year, generally not.
So if that's the case, then that would be way smarter for people to do the 40-year. Even if you want to pay it off in 30 years, having the flexibility to have the extra 10 years means you can pay it off earlier after those 5 years.
Exactly right.
But if you get in trouble, you don't. Your payments lower, that's locked in, it's safer.
Let me say something here. I used to be very anti-interest only, but something, because don't get me wrong, we want to see the amortization go down. Basically, the principal going down so that eventually you pay the property off, all that. But who here? We just talked about high insurance rates. What's coming next is high property taxes, because St. Tammany Parish reassesses every 4 years. Well, the last reassessment was 2020. And so we're looking at that next year, right? So what that interest only does is go take a look at one of your loans right now, if you have one, and just pull the principal payment out and see how much lower your payment would be. And then the point there is, you can be making that payment, but put the principal in a different bank account or something. But the idea is you're not forced to have to make, let's just say your principal and interest would be $1,000 a month. Well, what if it's forcing you only pay $700? That $300 can afford you a lot of opportunities right now with rising costs. So there is some power to that. Keep in mind. I don't want to hold you here. Is this y'all's biggest product?
Currently, yes. So to be fair, this is a fairly new. So I've been with the company for about 4 years, and this came on right before this product came out in the world, right before I came on with the company. It's a lot more common recently. I'm sure you've seen all kinds of DSCR lenders and asset-based lenders. It is definitely our most popular product right now, but that's what's nice about having both product offerings and a range of flexibility within those products to kind of keep us balanced and also make sure that we're offering everything that we possibly can for our borrowers. Sure, Lauren. Yeah, I'm sorry. At this point, we got questions going. So
what numbers are you looking at as a person? I know most of them look at 1.25 DSCR. What about y'all?
great question. So We'll get you a drink afterwards for helping us out
No,
in the
give her a book.
presentation here. Oh, here you go. Take a book. Which one would you like? We got three to offer tonight.
I was talking about that today. That
So-
I always read books.
That's a great question. Choose wisely. So much like a community bank or a credit union is going to have a different term and length and amortization period than we are, they're also generally going to have a lot higher of a liquidity requirement. They're also probably going to have an ongoing underwriting process, meaning once that loan's closed, they're probably still checking up on your personal financial statements, making sure that you are liquid to maintain across your global asset, whatever it is that you own in terms of investments, in terms of real estate, that you are liquid to maintain that throughout the life of the loan that you have with them based on the property. So you're absolutely right that they generally require a higher debt service coverage ratio at 1.25, and they also generally do factor in vacancies, management fees, utilities, all of that good stuff. We do not, again, just to remind everybody, and we can go all the way down to a 1-to-1 ratio.
Really?
Can you
Yes.
explain what DSCR is real quick for someone?
Absolutely. So say the rental income on your property is $1,000. We need the principal and interest on the mortgage, the taxes, and the insurance on the property, inclusive of any flood insurance and HOA or condo dues, to be at least or no more than $1,000.
So
Does that make sense?
So that's 1-to-1, right? Some require 1.25. So if all of your expenses come out to be 1,000, your rent has to be 1,250. Do you see?
Exactly right.
So there's a level. So what it demands is you have to just be able to get just a good. You have to have a level of cash flow.
Absolutely. And so the point is with all these programs is it's meant for people that may not have as institutional money at their disposal or even private money at their disposal, but there is generally a reserve requirement, just something to be aware of. It's generally 6 to 9 months of payments, and that just needs to be shown on an account. It's not collected at closing. It's not, we're generally not seasoning it, but just, so that we're aware of that.
So if the payment each month would be would be 1,000, you would need 6,000 to 9,000 sitting in an account.
Exactly, and that could be, obviously a traditional checking or savings account, but it can also be an investment account, a retirement account. We can take lines of credit. Historically, lines of credit with, volatility can get called back if they're not drawn on. So that is one thing to know.
Might tighten up.
They may tighten up, especially big banks. A lot of them aren't even offering lines of credit right now, so I will mention that as well. If you do have a line that you're hoping to draw on, I would, if you're looking to do something actively, I would take it out and make sure that it's in an account that you can use it from. Yeah, sure.
How about like equity from another house?
Great question. Unfortunately, not unless we're putting it into the loan. We do have the option to blanket loans together, so we can cross-collateralize loans under properties under one loan. That would be a way that we could maybe tap it or refinance that property specifically. But yeah, as on paper, we wouldn't be able to use it. All right, and a couple other things to look out for. It's specific, really, to the DSCR program. Is a big one right now is vacant refinances and declining markets. Declining markets meaning an appraiser has 3 options: increasing, stable, or declining. So if they annotate in the appraisal report that the property is in a declining market, that can be problematic and again, these are more high-level things from, all asset-based lenders that you should look out for when you're underwriting your deals. So declining markets, again, can generally come with a haircut of leverage at best. At some point, it may also come that they cannot do the deal. It may disqualify the deal.
What does a haircut of leverage mean? Like what percentage alone of the deal?
Exactly right. So if maximum allowed for the program is 80% of a purchase, haircutting leverage means we might only be able to offer 70 or 75 on that particular property. Good question.
I'm sure you haven't seen those for years, but have you started to see any declining market in things?
Unfortunately, we are. It's not generally, it hasn't killed any deals as far as I know.
Are you
but
seeing
we
it
are
in the
seeing
New
that.
Orleans area?
We have not quite yet.
Okay.
And the other side of that is that's purely an appraiser metric. That is not a lender metric. So we don't really know what their threshold is for that. I would just say we're very communicative throughout the process, and we try and take a hands-on approach to quarterback everybody throughout the process, including the appraiser, just to make sure that there's open dialogue there. So I would encourage that with you too as well, and know that we'll take that hands-on and forthright approach there too. They can refinance the same thing. They can haircut leverage or not do the deal. So meaning if the property is not occupied at the time of a refinance, purchase it's not a big deal because we can go off the market rent in the appraisal. But a vacant refinance is definitely something to be aware of, or it might also be worth waiting until the property is occupied to close the loan. Multiple members of an LLC, it's not too concerning, but just be aware of minimum credit requirements. There's generally, a big one is credit history, personal credit history. While we are lending to an LLC, we definitely care about personal credit, even if it is just a number, and even if that might be somewhat arbitrary, it does show likelihood to repay, past payment history and things like that. And yes, please.
What's the minimum credit you're working with?
620 is bare minimum for either program. Generally 700 is the minimum for maximum leverage, meaning if you're looking for that 80% on a purchase or 85% and you have the experience on a fix and flip, we'd like to see at least a 700 or so. But again, human element to some things, so we can always definitely talk through most of that stuff.
Do you choose your own appraisal or
Great question. So short-term loans, we have the ability to go directly to an appraiser, and we have a built-out panel of a number of appraisers in the area, probably upwards of a dozen at this point, specific to the South Shore, the North Shore, the West Bank, even into the Mississippi Gulf Coast as well. And if you, to that point, if you have an appraiser that you'd like us to use, we generally can get them onto our panel. We just need a copy of their license, errors and omissions, and insurance, and a resume. And I can take care of that personally for you as far as getting them on the panel. As far as lease types, I know a big thing that might be like a subject to or a lease to own or something like that. Just note that those are generally not allowed because they're showing that there's a potential that that the property may be paid off or under somebody else's control before the loan is up. So
refinancing, if you've already done it on, say, a lease option, or you're selling it on a bond for deed or something like that to someone, and you're the owner, but you're trying to refinance, it's the fact that you can't control that person buying it out from underneath you type of thing.
Exactly right, and it might be worth restructuring the lease at that point. Obviously, we'll make sure that you know about all of this on any in the early stages of any particular deal, but just general overview there. Seasoning period, I got my man Tony Sacheret there to help me out.
You get brownie points for that.
Yeah.
Tony Sacheret.
That's right. So seasoning period's a big one. Trust me, I know all of my investors down in the area here love when that number goes down. They don't like when that number goes up. I don't either. We were actually talking at dinner a little bit about what a seasoning period is. And that's, essentially a seasoning period is the amount of time that you've owned the property. And because we require so little documentation, the 5 or 6 things that we require are going to be LLC documents, title insurance contact, a homeowner's insurance contact, an appraisal for the property, a lease for the property, a purchase contract, and reserve statements to show reserves for closing. That's pretty much it. Because of that, the big thing is seasoning and skin in the game. So skin in the game, your actual equity, your cash in the deal is something that's very important to underwrite. Seasoning period currently right now is 6 months, meaning at 6 months in a day we can fund the loan. It's not that we need 6 months to start the process. So that's a big thing. Like a lot of different banks, they may need you to own the property for 6 months and then they can start the process. We can tee this up so where 4.5, 5 months into the deal, we're getting you lined up to fund it 6 months in a day, or whatever the seasoning period is plus a day, essentially. This was actually a good one from this past weekend. A bond for deed. I know that's something that's very, I shouldn't say very common, but way more common here than it would be in New Jersey. And historically, it's been an issue for us in terms of our committee being able to wrap their head around what this is and how we can move forward with it. Because specifically in a bond for deed, the big thing with us is title needs to vest. And somebody might say, hey, Ryan, I've been on this bond for deed for 2 years. I've collected rents, I've paid taxes, everything like that. But title is still not in your name. So for us to be able to treat that as a cash out refinance, meaning you've owned the property for 6 months and we can use the newly appraised value, we need that title to vest. So,
but seller financing, if the title's already in your name and the owner is just like in the first position getting payments, it might be a little bit different. Like for example, If you structure a seller finance deal and they tell you you got 5 years to cash me out or 2 years, you know, with that 6-month seasoning period, you guys could start working with, you know, that
100%.
process.
So the way that we've, I'll give credit to Banjo, if anybody knows him, Eric Carmerdell, and he's in
Mississippi.
I know he's in.
County.
Okay, yeah, he's in Mississippi. Look him up if you need a good realtor in the area or his team. But he actually had a really good suggestion where you flip that bond for deed essentially to a seller finance option. You can do a 12-month term, no payments due throughout the process, and then a balloon due for whatever is owed on the actual deal 12 months into the deal, which is huge because now we're getting around that. Title is actually transferring. You have 12 months to make that happen. And you also have, you know, that covers us for the 6 months, or if you're looking to just restructure whatever the note was due on the bond for deed, you can do that right away. So just a couple things to mention there. Mixed use and multifamily, not going to talk too much about this. This is actually another 6-unit property of somebody that we've worked with in the past. Multifamily, so 5 to 10 units is generally something that we can do. This is, I'll be honest, fairly new, a newer offering for us. We had them in this space about 18 to 12 months ago, but with the volatility at the beginning of 2020, that was one of the first things that was pared back. So just something to think about there. But we do have long-term financing that's starting to come back and be a little bit more available. So 5 to 10 units we generally don't have an issue with. 11 to 30 we can move forward with on an approval basis. So we'll do all that front work. And that's something that I try and do personally on my deals, much to the chagrin of ownership sometimes, because I do like to take the hands-on approach of somewhat underwriting the deal first so that we're putting you guys as the borrowers in the best position possible. It may end up that we ultimately don't do that deal because of that underwriting process, but I feel a lot better about you knowing exactly where you're going to stand with us or with anybody else in the space, and as opposed to getting down the road with somebody and then ultimately you've spent money on appraisal, you've had a hard inquiry on your credit, things like that. We do have bridge loans and DSCR loans available for both of these asset classes. And as I mentioned before, specifically for mixed use, it does need to be 50% residential by square footage. Just going back very quickly to 30-year, I know a big thing too is short-term rental properties. So good thing, you know, we have the ability to finance rental properties, I will say, but the good thing, or the thing to really be aware of is the rental income. If that has been a short-term rental property for the last 12 months, and we can verify that income through Airbnb, VRBO, a property manager, or a CPA, we can use that rental income to base our debt service ratio off. If not, we're going to defer to the market rent in the appraisal, just to mention that very quickly.
But you're still going to require that appraisal for the what percentage of amount that you'll...
Exactly right. We do, even if it is a short-term rental property, say you're looking to purchase something that was owner-occupied prior to that, we're going to, say even if you were buying something that had been a 12-month, has a 12-month history of short-term rental income, we're still going to get an appraisal with 3 to 5 gridded out as-is comps to justify the value, but also 3 to 5 gridded out rental comps to just show what long-term market rent is in the area. Sure, this is something that, you know, most people in the room are familiar with. Everybody heard of the BRRRR method for the most part? Okay. So we're not going to spend, again, too much time here, but the way that we just essentially parlay both of these programs together, where we can help you acquire the property, fix it up, and then if you're looking to keep it as a rental, we can help you stabilize that on long-term debt with the 30 years.
Using the short-term loan for the renovation and to stabilize the property, and then going ahead and doing the long-term DSCR loan for the 30 years after you renovated it, rented out.
Exactly right. And there, you know, obviously in markets like you mentioned where people like us really don't know a bad market, you kind of got bailed out by the market in certain cases where you bought something, maybe you paid a little bit too much for it, maybe you put a little bit too much into it, but the market came up and kind of saved you on that 6-month or 12-month appraisal, and you still were able to get a little bit of your, if not all of your down payment, your equity, and maybe a little bit on top out of it as well. That might not be the case so much with this market compression that we're going to see, I think, moving forward.
Ryan, is that an additional fee? Is it a refinance or is it a roll?
It's a very good question, Amy. So it is definitely 2 different loan products. It's definitely 2 loan processes. It is a new closing. We don't have like a streamlined option, but again, we can certainly time it to when You know the rehab's going to be completed. You have a good idea of when we're going to get a tenant in place so that we're at least getting that cost basis off the table and back into your pocket so that you can recycle that money for new flips or just keep it as profit at that point. Sure. We're just going to kind of skip through this because we talked through very quickly. You can hit, yep, back. So real quick, just a little bit about the market right now. Obviously, the biggest indicator of rates is inflation, and we've seen runaway inflation over the last, pretty much 12 to 18 months at this point. And as you see, it's just really and I'm happy to share these slides after. I'll also make sure to send Courtney a hard copy for you. It's really just showing the pattern of what happened in inflation. Burns and Volcker were the Fed chairman the late 70s through the 80s. Alan Greenspan was early 90s throughout the mid 2000s. Jerome Powell is our lovely Fed chairman today. So it just really shows, as there was a huge jump in inflation, what the response of mortgage rates was historically throughout those time periods. And then it obviously shows, by extension of that, what the Fed funds rate went up to try and curb that inflation. And then it just does show the historic inflation response once those Fed fund rates had been increased. So we're hoping, Friday aside, we'll see what happens. Maybe that is a little bit, does accelerate this process, but the one thing that I did hear over the last couple of days, it was actually this morning I was reading something that taxpayers will not be directly impacted by the bailouts of the banks, but the other side of that is the Fed may just print more money, which will cause inflation.
So the White House also showed on their Instagram yesterday that the economy's heading in the direction they want it to. So
take that as you will. I'm certainly not any type of politician.
Well, this is a good time to talk about is, as you guys know, I want to, number one, bring you some great resources. Brian's been helping you guys understand this product, right? One of the things we talked about is you do want to be careful, for example, with the short-term loans, because what if a lot of what you're doing is you're underwriting today and you're saying, hey, within 6 months, it has to be able to sell at that price, or it has to be able to, for example, to do the BRRRR method, to refinance at a certain price, right? Or to cash flow. And so one of the biggest things here, these are some great products, but you also need to level it off with some of that being cautious, because, if anyone says they know what a price of a property will be in 3 months, 6 months, 9 months, 12 months, run. Because none of us can guess that right now, because none of us know what tomorrow's gonna look like. So you do want to balance this out. The question I told you about, how are you guys helping with the changing markets with your clients? Because the last 6 months we've been seeing some shakeup. Anything you want to talk about with that, with these short-term loans, or when the refinances might not be going as planned?
Yeah, no, that's a great question. And, it's, to be clear, and just so that everybody's on the same page, the Fed fund rate increases do not impact your 30-year mortgage directly. So it's not to say that if you had been quoted, even for your primary residence on a fully docked out loan, if you had been quoted 6.5, now you're, and the Fed is increasing the Fed funds rate by 50 basis points, that your rate is now 7%. Those are more short-term rates that those are based on, just so that everybody knows that. As far as where we see things going, I think we're firm believers at First Equity, and I think throughout the industry, that we're going to see some more favorable rate environment towards the second half of this year. What that looks like, it's extremely tough to say, and I agree with you. If anybody says, hey, this is exactly what it's going to look like, probably run. But
So what is it right now?
I'm sorry?
Do you have like a flat rate as a DSCR lender?
We
No,
do
it's
not. So
individual.
that's based on all the things that we talked about in terms of credit and cash flow. But for somebody with strong credit and low LTV, you could certainly be in the mid to low 7s, whereas somebody that's probably not that far off from somebody who's putting 30 to 40% down on their house with 800 credit and a fully docked out loan for a primary residence, just so you know, or for a little context. So yeah, that's just a little bit there historically. And again, inflation reduces mortgage rates. That's been the whole thought of the Fed, and what they're trying to do here with increasing the short-term rates is to try and combat that inflation. Just a little chart to show historic rates there. And then, one more, just real quick on that one. Supply and demand. So a lot of people are concerned about the environment we're in right now being very similar to 2008. The argument that we would say that is against that is that if you look right here in '07, the housing market was propped up on bad loans by borrowers that maybe shouldn't have qualified for those. If you see, there was 3.7 million homes available in the market at that time. If you look, this is actually slightly outdated. This number is actually even lower than that right now. We're talking almost 3 million homes less. So, a huge market difference in what's available in the market, and I'm sure you're all seeing that in your environment, your markets here. So thanks. Perfect. Real quick, just tips for flips. Time and cost of values, the three biggest things. Obviously, the biggest one there most likely is time, because you can never really get that back. Historical property info, what that's talking about there is just be aware of what's, especially for flips, be aware of what's out on the internet, and try and, if there's old listings that show like mold or flood damage or anything like that, try and get ahead of that for your own sake, to just, especially if you're selling a flip, so that you can show that that has been remediated properly. Don't wait to be 100% done, or at least stage your properties virtually if they are not completed, because it just goes, that little extra bit does go huge, pay huge dividends in terms of your marketability of the property. Same thing with professional photos, staging, and loan qualifying. It's really just a matter of being aware of what is up, staying in front of your loan officer and making sure that they're updating you on what is going on currently in the market in regards to their programs.
And also too, for the property to be loan qualifying, because I walked a house the other day and the seller was wanting to know all their options. One of the number one things I'll talk about is what will stop a property from them being able to sell to someone who can buy with a loan.
Sure.
Certain things in the house, really easy. Some stuff as simple as the carpet being pulled and there's just, subfloor in certain rooms can disqualify the property from being able to qualify for a loan. And some people don't know that.
Very true. Yep. So again, just a example, like you don't want to have pictures like this here where there's trim laying on the floor, there's tools all over the place. It's a much different visual, even if that's all it is just in the buyer's mind. They can help. It helps them to visualize how they're going to be in that property. Like I mentioned before, remediation of previous defects is a huge one, especially flood and water damage is a big one, obviously down here as well. And then professional photography, videography. If you're a guru at that stuff and can do it on your own, highly recommend it. But if not, it might be worth a couple of dollars to have somebody else get involved and do that for you. Same thing here. This is just an old listing showing that this was previous to the actual flip listing, and it was still out there on the Zillow interwebs. So just be aware of what is out there. Same thing here, not to beat a dead horse. You can also obviously digitally enhance this so that at least it's green or there's no weeds or something like that. Examples of real staging, and then examples of virtual staging. And if you ever needed any help with that, let us know. Quick tips for landlords, because again, most of us are investors ourselves. So tenant screening, obviously this is a pretty easy one, but always try and do the bare minimums. Obviously you don't want to get involved in any fair housing issues, but to use a property manager to help with that tenant screening is also huge. Property management software itself, a couple different examples, Billium, Appfolio, or Rent Manager. Vacant listing syndication, that's something that's a little bit more higher level for bigger units. That's more for the big multifamily properties.
So those are some different sites you can actually put. It'll syndicate through various of those sites your available listing.
Exactly right. So if you put one listing up, it'll go throughout the entire Zillow group, which I believe is Realtor.com and all that good stuff. And then tenant self showings. This is kind of a newer one that Anthony, who is one of our more active investors and also one of our loan officers, they essentially go through the pre-qualification process, and then they get sent the one-time code to a lockbox on the door. They can go check out the property and FaceTime with you when they're doing that. Obviously, they'll be pre-screened most likely beforehand. 24-hour answering service. This is actually a big one. I was with Anthony a couple weeks ago after we did our own REIA meeting, where he had a fire call, and somebody's calling him. It's just little things like that. It's actually very cost effective. So if you'd like any resources there on what might be available, I can certainly do some deep digging for you and get you some of those resources as well. And then it's all about ease of use and just ease of the experience. Tenant portal or online payments generally available through your property management software. Just something to mention there. Again, not a huge reinvent the wheel type suggestion, but just something to be aware of that might be out there. That's really it. Anybody have any questions? Sir?
How big of a property we y'all did?
Is big in terms of land area or big in terms of units?
I got some private finance, got a 58 unit apartment complex in New Jersey, right across the road from New York City.
Okay.
He's $34 million, 58 or 59 units are full. The rent starts off at $7,000 a month.
Wow, that's big numbers right there. Yeah, unfortunately, we're out of that state. Really, we're in the 30 units or so right now. It's a good question, though. To be fair, we're never going to turn a deal away sight unseen. The biggest thing that I will say is that we're never going to waste your time either. We're very cognizant of that. We want to make sure that we're helping you. Even if by helping you, we're giving you a quick no so that you can get on to the next one. And, hopefully you come back to us for what might fit into our box. But yeah, we definitely want to be very cognizant of that too, that we're not wasting anybody's time or trying to string you along for something that might not exist. Amy?
Time to close on a different one.
Great question. So generally for either product, it's about 30 days, I think is a very conservative ballpark. Biggest indicator of that is going to be things that are somewhat out of our control in terms of the appraisal, in terms of title insurance. But like I mentioned before, we're very active in trying to quarterback the situation to make sure that everybody's pushing towards closing as quickly as possible, especially in purchase situations. Obviously, we know that's a little bit more time of the essence there.
Last question across.
It's okay.
So what kind of fees, like the total fees, between origination fees, between like appraisal, inspection?
Yeah, sure. We're very, well, so the appraisal, you paid,
Points, do you
just,
offer points?
yeah, we do. So very high level and very quickly, our entire fee schedule is very simple. For both programs, we're going to require a $35 application fee. It just covers our cost to run credit and background checks. We also, that and the appraisal will be the only two things that you pay for before closing time. The appraisal fee you pay directly to the appraiser. We do not get involved. We do not pay that fee at all. So just so you know there. And then closing fees, we have a commitment fee of $9.95 for the rental, the short-term loan, and then $12.95 for the 30-year fixed rate loan. And then we also have a $1,000 legal fee. So it's legal fee, origination fee depending on the program, and then the background and the appraisal. And then we also have points if that's subject to the rate, depending.
So, okay, so I have the handful of questions I want to ask.
Sure. Please.
All right, how should someone, so one of the number one questions I get, so some of you guys are in, we have a group that has a few thousand people in it on Facebook, and we moderate that one heavily, but there's a lot of groups that are not moderated, and you get hard money lenders, these various types of lenders from Lord knows where, probably Nigeria, but how do you recommend someone should vet a hard money lender so that they can know that they're not getting, someone who's a fly-by-night person, again, the Nigerian prince situation?
Sure. There's a number of different metrics, and the biggest one that I would say is talk to that person. Like, make sure that you're actually engaging that person and making sure that they're responsive to you. I'll make sure that everybody has my contact information. If you ever have any questions, Courtney and Steve, I think a couple other people in the room who we may have spoken with in the past, I think they'll attest to the fact that we're here for the long play. We're certainly not here expecting every call to be a deal, and we also appreciate the calls that aren't a deal because it knows that you're thinking about us in other capacities, and we'd like to be here for you in that capacity. Big thing that I would say is, are they a direct lender? That's probably a number one, but it depends on their structure, I would say, and we are a direct lender, so I will say that too.
Can you define what a direct lender is?
Absolutely. So what that means is we have a fund, a pool of money that has been raised from friends, family, other investors back home. Separately, that's an investment opportunity if anybody would like some passive real estate investment. We can talk about that at a different time. But it is our money in the deal. So meaning we are funding it, whatever the loan amount is, that money is coming directly from First Equity. It's not coming from Rock Capital or any other big conglomerate that we're brokering to. So that's what.
So if they're not direct,
it's not to say that they're not
they're
competitive.
like they're a salesperson for someone who's it's their money or something like that.
Exactly, or they're a broker trying to aggregate the lowest and best deal in best. I mean, you know, sometimes the race to the bottom can be you get what you pay for as well. I certainly think that being said, I certainly think we're competitive, but you want to make sure that you're actually dealing with somebody that is reputable.
Who here is in the room that wants to share? You don't have to share about it, but just who here has done an actual closing with Ryan? I know Steve has, but I think that's so that's one of those things where it's also good to talk to people. And so obviously there's someone in the room you can talk to, but that's one of the biggest things when you're vetting a hard money lender. If no one has heard of them or no one has closed a deal with them, I mean, that's something that I highly regard as talk to someone who did a deal. Hey, how did that deal go? Were there any hiccups? You know what they told you, and then what was actually delivered on. Is it the same? Those are some of the things I say. Hey, keep in mind.
Absolutely.
Anything to stay away from if you see in a hard money lender, maybe that you've learned from the industry.
For me personally, it's tough to say, but like I do know, like a lot of the times you'll see like 100% financing or things like that. Like it's not to say that they may or may not fit the right deal for you. That's one to be very cautious of, and at least to Courtney's point, like just ask somebody if you have somebody who's used that person and they've delivered on what they told them. There's really nothing more that you can go off of based on that. And I'm a firm believer in word of mouth and referrals, you know, as best as possible. Again, another reason that I am here today.
So some of the things you want to be careful of, if they have a Gmail account or WhatsApp, those are sometimes like a red flag, right?
Absolutely.
And then, or if it's, you know, a lot of times you just want to be cautious with that, you know, because ultimately you want to make sure. A big common scam with hard money is, hey, pay this, you know, so they're paying $35 to you before going to closing. So that's only $35. But then they might be paying $400 for an appraisal directly to the appraiser. But some people say, hey, $1,500 up front before we go to closing. And a lot of times they get taken, you know, to the cleaners for that $1,500 because, you know, that person may just be like, how many people can I get for $1,500, right?
100%.
So a common thing here, that's one of the things I want to kind of just speak to because people call me all the time, text me all the time, hey, I found this person on the internet because they had 100% financing at 2% interest yesterday. And, you know, that's too good to be true. You want to be careful with that. And then anything specifically that you've been changing in the last 6 months right now or changing currently with the changing times that you want to talk about?
Good question. So historically, we had been able to, the fix and flip loan, or the short-term loan specifically, we had been able to get up to 90% of the acquisition. And that was actually pared back down all the way to 80 for our most experienced investors about 9 months ago. And about 3 months ago, it did get bumped back up to 85%. So that's been big to see those types of things coming back. The other thing too is, you know, as I mentioned before, seasoning periods, whereas that was 6 months of a seasoning period 12 months ago. We were talking about going down to a 3-month seasoning period, and then we went the complete wrong way and went back up to 12 months. You needed to own the property for a full year before we could use 75% of the newly appraised value. So,
Where are you currently at?
6.
Okay.
So the other thing that I would ask maybe is just, do they invest themselves? Do they know their products? Do they know their guidelines? Do they know the wonky situation that you're talking about, or might have the deal that's coming across your desk? Like, do they know how to handle that? And if they don't know how to handle that, are they just telling you, are they just spewing words at you, or are they actually taking ownership of the fact that they don't know something and say, hey, give me 1 second, that's a great question, let me get back to you about that. I'd love to go ask somebody else who might know a little bit more than me so I can give you the best information possible. That's something that I would also mention as well. And how to avoid defaults, and like it kind of goes to what we were talking about before about how we'll help you underwrite your deal on the front end of things. I mean, if we have an inflated rehab budget, or if we don't think the rehab budget is enough, we're going to try and point those things out for you so that at the end of the day, we're not putting you in a position where you don't want to be.
Do you want to give those books out?
I do. Lauren, you've asked it. Oh, wait, no, you already got
You
one. You already got one. You can't have one. Another one. Any?
See, it's hard, right? It's hard. It's hard to do. You gotta figure it out.
What's my favorite sports team of all? It's a New York. It's not the Saints, but they're growing on me.
You haven't covered that
What was
in the
that?
talk tonight.
That's no Pats.
Did he mention that? No.
Yeah, it might sound. There we go. All right, Mike. We got one, and
Because everyone's just guessing right now because no one heard you say that. It's not like you have it on your shirt. Who's first time?
what's that?
Who's first time at the time?
Whose first time is it tonight? Oh, so now we have a follow-up question. All right, keep your hands up. All right.
So you have to raise your hand.
Do we lend on new construction deals?
Yeah.
We do. Or not?
Yes.
We do?
But only
What's the biggest hurdle?
if you have, you said 5 to 7.
Whoa, I wasn't even asking for the number. I was just asking what the hurdle was.
Way to go. All right, Slam. Any last dying questions for Ryan? Amy?
Yeah, and I don't know if it's for Ryan or for you or him for both. But so most of my experience with loans is what I understood to be asset backed because it's just based on, for flips, based on the value of the home or what it would be after renovation.
Sure.
A lot of your slides said hard money and then it said asset backed in parentheses, but as far as I know, what
They're
people
the same.
what people have told me is, oh, if you're dealing with a wholesaler, for example, you need to get a hard money lender because they can close in 7 to 10 days. I thought that that was the defining difference.
Yeah.
And so can someone re-educate me on that?
Hard money is just a generic term for, like, it's almost got, and that's honestly why we put asset-based, is because it's almost got a predatory connotation to it. And while it is the vein of what the products that we offer, and that's the other thing too, is there's a very much a spectrum. To Courtney's question about trying to vet out a lender in this space, there's no accreditation, and that's the other thing to maybe look into too, is if they do have an NMLS license, which I do. I mean, I have the ability to finance conventional properties as well. You know, it's really just a matter of it's hard to quantify integrity, I guess, but yeah, no, hard money, I would just say, is that short-term loan. I think is where people generally consider that short-term loan, low, requirements in terms of documentation, higher rate, no prepayment penalty, 12-month term kind of thing, whereas, the DSCR loan, the rental loan is more asset-based in that it is truly based on all of them are based on the asset. But I think that's where the difference is, and historically that connotation comes from.
What's a
Sure. Oops, sorry.
On that 30-year loan, is there like a minimum loan amount you guys do? Or?
It's a great question. So generally it's $100,000 to $150,000 minimum loan amount. It depends on the property. Again, it's not a hard no. I mean, we've spoken with people in the past where we can get around minimums. Really anything short of credit and background issues like felonies, bankruptcies, foreclosures, judgments and liens, those can be tough depending on the timing, but they're certainly not non-starters. The only thing that I would say is, bring it to us, and I'll tell you if it's a no, like I said, I'm not going to waste your time.
So loan amount, not just the value of the property, because they're going to do a percentage of that. What's the quickest you've ever been able to do a loan for a transaction?
It's a good question. I would say realistically, probably 2 to 3 weeks, depending on like if we had some things things lining up really, really good. Like the appraisal coming in right away, title work coming in right away, borrower's very good about getting us the few things that we need to.
This is important.
Documents. Yeah,
it's hard to steal in slow motion,
It is 100%. The other thing that I would mention too is, especially to that point exactly, where seller is requiring 3 to 7 day close, and that's it, or you can't get the deal. The one thing that I would mention is we do have the ability to do what's called delayed financing, which is where we essentially come in as if you have the ability to take that property down with cash within that 3 to 7 day or whatever the time frame is, we can start our process at that exact same moment. And then what we'll do is once our process is finished in our 3 to 4 weeks, we just backfill you on what you had put out into the property. Does that make sense? It is essentially a refinance, but it would be considered a delayed purchase from an underwriting perspective, and we would base it the numbers on if it was a purchase. Other.
Well, I got a quick question for you.
Sir.
2 weeks is pretty good for a lender. But say it's the second loan. You've done one, you've got all the docs on the person. Can it go a lot faster? We're just waiting on title and appraisal or?
100%. So like that's, to your point there, sir, we're very much about the relationship here. We want to make sure that we're helping you get everything done in whatever time frame you see fit. And if we can reuse LLC documents because you're using the same entity, we're going to do that. If we know your title insurance person that you're going to be using for the transaction, we're definitely going to be able to, already preactively reach out to them, or preemptively reach out to them. So it's a great question. If we've even been able to reuse credit reports, if you're looking to finance a property, a second property within the 3 or 4 months that original report is good for, then we don't need to ding your credit again. It's a great question.
Can you explain what's getting passed out to them right now?
So what's getting passed out is just a very brief overview of the bullet points of the programs that we've spoken about today. It's just essentially a little bit of a, like I said, a checklist or a high-level overview of the programs, the terms, what they're generally used for, the property types that we can finance within each, and then there's some a leverage grid at the bottom, just showing exactly what it is that our maximums are at the moment.
I'm looking in a couple different states right now.
Sure.
And off for this weekend. Do you have any states you don't?
It's a great question as well. So we generally are in 40 to 42 states. The ones that we cannot lend in, mostly out west, are California, Nevada, Arizona, Washington State, Minnesota, North and South Dakota, Vermont. But as far as the Southeast, the Midwest, the entire Northeast.
They pretty much have a satellite office here in New Orleans, so they've been out here and then into Mississippi pretty frequently, which is where most people are right now, but a lot of those other states.
I'm looking at Pensacola right now.
Yeah, Florida actually, so I personally do a ton of business in Tampa as well. Florida's a booming market, and they're had been, but definitely something.
Let's recap some of the things that you are not a good fit for, just so that people can remember this.
Sure.
Land, yes or no?
No. So no land, no strip malls.
Well, I could go through a list.
Sure.
Strip malls?
No strip malls.
Strippers? No, I'm just kidding.
No strippers.
Trailers?
No trailers, no mobile homes. We are talking about mobile home parks, no storage units.
Okay.
We are talking about modular homes though, so prefab homes. That's something we need exact clarification on that, but I don't see any issues there.
So 30 or more units, multifamily?
No.
Okay. And then what about, and then low value properties, so under 100,000 ARV, those can be?
Those are a little touch and go. I would say, especially for long. High value is a great question too. We generally have about a $2 or $3 million cap on the property value.
Okay. And then, but then you can help people on new construction, but it depends on your experience level.
Exactly right.
Flips, so the short-term loans to come in, fix it up, and sell, or they can also pair with a refinance of some sort. You don't have that experience, correct?
Exactly correct for the short term.
Okay, because that's big. Because some people, sometimes they're, and a lot of times too, your terms are going to be based on your experience level, just because of your risk level. Okay.
Exactly.
And then, so in your short term is what, generally 12-month period?
Generally 12 months. I know it only said 12 months on the slide there. We can do 18 or 24 if it's an extensive project. We can definitely talk about that on a one-off.
Okay, and then for the DSCR loan, all right, so those are single families, can you do condos?
We can do condos, townhomes.
Things like that. And then 1 to 4, you can also do 5 to 10 units.
Yes.
And then 11 to 30 is
on a case-by-case basis.
Okay, and then, okay, anything else that's a common misconception, anything like that?
long-term and short-term rentals, we can definitely do both. As far as misconceptions go, you know, it's tough to, because there is such a spectrum. There's not like while I have my MLS license, there is not a licensing requirement to sell these types of loans. So again, do the front-end work to try and make sure that the person that you're dealing with is reputable. Make sure that if you can't find a referral from somebody, online. I mean, you can Google me. I'm sure the first thing that comes up is, you know, stuff relating to either First Equity or maybe College of Charleston or something. I'm not sure, but see what they have out there is my point.
So one of the other big things here is a common myth with hard money loans and these asset-based loans is that you don't have to have any money to do these deals, when that's not true. The short-term products, you have to have a percentage of that purchase, okay? The other thing is on the refi, you're gonna have to be able to show that you can handle some reserves. And so this is not the type of product for someone who's like, hey, I don't have any money, I need someone who, yeah, I have good credit, but I don't have any money. Those are some of those things that you want to make sure that this is a good product for a few different peoples, but maybe it's because you have some money, just not enough to cover the whole purchase or something like that.
Yeah, the only other thing too, like, you know, just to kind of, to Amy's point before, is like, if somebody's offering you like 100% financing, they're probably charging you like 20% interest or 14 points or 14% with 4 points or something like that, which might be worth it to you because, you know, I don't know, but just see what else might be out there. And like I said, if nothing else, I can be your sanity check. And if you're better off suited with somebody else, I'll be the first one to tell you that.
So we're going to go ahead and land the plane here, but are you coming to Chimes?
I will be at Chimes. So I have to leave. I have an early flight tomorrow morning, but I have to leave a little early, but I'll definitely
So we're going to be hanging out here for just a few minutes while we break all this down. But if you guys want to join us, we're heading over to Chimes. You got to make the loop-de-loop, keep going that way. It's about five red lights. But we're going to go ahead there, grab some drinks, some food. But thank you guys so much for coming out. Let's give it up for Ryan. And thank you guys for coming out. April 11th is our next meeting. We'll see you guys next month. Come grab his card if you need one, but the rate sheet's helpful.
Just a Jersey joke. Thanks for having me. Sopranos up there.